Welcome to the world of Test Portfolio XSX. This video was created with the help of artificial intelligence. It provides a weekly summary of key economic events. The featured portfolio is simulated, fictional, and reflects my personal perspective on recent market developments. My main goal is to explore whether the S&P 500 can be outperformed. To do this, I compare the performance of three different portfolios: my own fictional portfolio, an S&P 500 portfolio built using a lump sum investment strategy, and an S&P 500 portfolio built using the dollar cost averaging method. This video reveals which strategy performs best and why. Disclaimer: this video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur. Ready to get started? Let's go. An inflation flash, Fed debates, and unexpected AI licenses. This week, Wall Street was shaken simultaneously by macro reality and geopolitical poker. Let's see how all this played out on U.S. equity markets during the trading week of July 14, 18. The first shock came on Monday. The June Consumer Price Index jumped to 2.7%, the highest reading of the year. Core inflation also crept up to 2.9%, while energy prices over the same period were still in negative territory. The fresh data revived stagflation fears and immediately pushed short-term yields higher, even though the Fed was still repeating the word patience in the minutes of its June meeting. Midweek, however, Governor Christopher Waller publicly urged a rate cut, saying GDP growth could slow below 1% if the central bank does not relent. The compassless communication sent ripples through the futures indexes, but tech favorites quickly clawed back the yield-induced losses. On Tuesday, China taught a lesson. Second quarter GDP growth cooled to 5.2% from the previous 5.4%. The Politburo hinted at further stimulus, but the PBOC is already navigating with a short rate of 1.4%, where bank profit margins creak. The slowing consumption and persistent deflationary pressure put not only the UN but also U.S. luxury and tech exporters under strain, because weaker than expected Chinese demand reverberates through global supply chains. This was partly offset by a U.S. turnaround. The Commerce Department granted NVIDIA and AMD permission to resume shipments of their H20 and MI308 AI accelerators to China. The stocks exploded, the semiconductor index embarked on a three-day rally, even though the Republican wing of Congress is already protesting, citing national security risks. On Wednesday, another jolt hit the trade front. Donald Trump threatened a 30% tariff on the EU and Mexico starting August 1st. While at the Aspen Security Forum, the defense sector elite feared that the trade war could override NATO orders as well. The rhetoric pushed the dollar higher, but share prices of multinational industrials slipped because investors priced in supply chain risks. The market is currently hoping that the White House is merely building a bargaining position. Geopolitical tension offered no respite either. Russia unleashed more than 300 drones on Ukrainian cities, while in northern Iraq, drones struck 4 oil fields. Yet Brent closed the week down 0.9% because investors interpreted Trump's 50-day ultimatum as meaning that supply will not tighten further in the near term. The energy sector's drop thus got a double hit. Geopolitical risk or not, the barrel price trickled downward. Meanwhile, the macro backdrop remained surprisingly strong. June retail sales rose 0.6%, and initial jobless claims fell to 221,000, declining for a fifth straight week. The Michigan Consumer Sentiment Index also bounced, partly because many people brought forward purchases ahead of the tough tariffs. These signs curbed Fed-related pessimism and helped the major indexes flirt with record highs again by week's end. Compared with the start of the week, by Friday evening the S&P 500 was up 0.6%, and the Nasdaq 1.5%, while the Dow slipped 0.1%. Classic defensive utilities led with a 1.6% gain, followed by the industrial sector thanks to surprisingly strong aircraft and rail news. At the bottom of the list were energy and healthcare, the former hit by the oil price correction, the latter by Medicare squeeze talk linked to the debt ceiling debate. On individual stocks, the spotlight was stolen by NVIDIA and AMD. The partial lifting of the export ban added 8% and 6% respectively in just 2 days. Bank stocks also perked up. Citigroup jumped 3.4% after quarterly EPS beat analyst expectations by 21%, while JP Morgan flaunted a USD $5 billion buyback firepower. reminiscent of the 2021 records. Thus, the weekly winners list is topped by the mega fund tech and big bank duo, while oil majors were dragged down by Brent's weakness. In sum, you got double exposure this week. Yields bounced because of the Fed's decision paralysis, but artificial intelligence and bank profit machines once again proved that on Wall Street today, the mega hype still moves the big hand. China may be slowing, yet it keeps American chip dreams alive, while Trump's tariff bluff forces every foreign partner to play it safe. The question now is for you. Do you think the Fed will ultimately be forced into a quick preventive rate cut this year, or will the market overshoot the central bank again? Post your view on the next move in the comments.
Roaring bank profits, surging AI chip sales, and an unexpected Pepsi rally in the second week of earnings season. You got a simultaneous macro boost in corporate fireworks. Let's see who moved the market from July 14 to 18. The star of the week was Netflix revenue of USD 11.08 billion, up 16% year over year, and EPS of USD 7.19, both beat expectations, and management even envisions annual sales around USD 45 billion. However, the forint's weakening against the dollar explained too large a slice, so the stock fell 4% when the perfect guidance failed to appear. On the chip front, TSMC, though Taiwanese, yet an ETF engine in New York, delivered a record USD 30.1 billion in revenue, up 44% year over year, and ADR EPS of USD 2.47, while 3-nanometer production already accounts for 24% of revenue. The stock jumped 3.4% on AI demand. Citigroup delighted investors with revenue of USD 21.7 billion, and EPS of USD 1.96. Consensus was USD 1.61. The stock rose almost 4%. JP Morgan beat estimates with revenue of USD 45.7 billion and EPS of USD 5.24, yet slipped 1% because management presented cautious NII numbers. On the broker side, Charles Schwab posted a record USD 5.85 billion in revenue, up 25%, and EPS of USD 1.14. The stock flew to a new high, up 2.8%. American Express, by contrast, corrected 2.3% despite revenue of USD 17.9 billion, up 9%, and EPS of USD 4.08, as investors worried about fee hikes on premium cards. Abbott Laboratories just squeaked past the target with revenue of USD 11.14 billion and EPS of USD 1.26, but cut its 2025 organic growth target. The red card came quickly. The share price plunged 8.5%. PepsiCo reported revenue of USD 22.73 billion, up 2% year over year, and EPS of USD 2.12, then reaffirmed its annual targets. Defense-minded investors rewarded the stability with a 7.5% intraday rally. GE is flying. GE Aerospace delivered revenue of USD 10.2 billion, up 23%, and EPS of USD 1.66, and at the same time raised its 2025 profit outlook to USD 8.5 billion. The stock climbed 2.3%. 3M reported revenue of USD 6.2 billion and EPS of USD 2.16. while margin improved to 24.5%. Nevertheless, it fell nearly 1% on caution over Trump tariffs. Schlumberger marginally beat the analyst consensus with revenue of USD 8.55 billion and EPS of USD 0.74, but the stock sank 3.7% due to international project slowdowns and ChampionX integration costs. This week, the financial and defensive consumer sectors clearly seized the reins. Bank profits and the Pepsi price explosion offset the healthcare blows. In technology, the AI chip fever still rules. But with Netflix, you can already see that lofty expectations can easily lead to a valuation correction. Overall market sentiment is rather constructive. The share of positive surprises is above 81%, and guidance cuts, Abbott aside, are rare. Which earnings report surprised you the most, and why? Let us know in the comments how long you think the momentum of banks and AI players can last.
The primary goal of the test portfolio is to outperform the S&P 500 index. The buying program started on the 19th of March 2025. Since then, the portfolio has achieved a return of 28.64%, while the S&P 500 has risen only 7.06% year-to-date. In other words, we have managed to secure nearly a fourfold gain compared with the US benchmark. In theory, I could close the positions now and reinvest the entire capital into an S&P 500 ETF. In that case, the current advantage would likely remain until year-end, meaning I would have already won the race. Nevertheless, I am continuing the strategy to see where the rest of the year leads. For now, I am sticking with semiconductor stocks. Nvidia is particularly promising, and several recent analyst price target increases support this view. Atif Malik at Citi raised his target from USD 180 to USD 190. James Schneider at Goldman Sachs initiated new coverage with a USD 185 target. Vijay Rakesh at Mizuho revised his target from USD 185 to USD 192. And finally, Vivek Arya at BofA Securities lifted his target from USD 180 to USD 220. Why is this important? Consensus premium. Most recent price targets have already shifted above the USD 180-200 range, confirming that the market is pricing a strong growth story into Nvidia. Catalysts: accelerating demand for AI data centers, sovereign AI projects, and the easing of Chinese export restrictions could all provide medium-term revenue momentum. Portfolio impact: because Nvidia is one of the largest weighted components of the test portfolio, the price target increases raise the probability of further outperformance, though volatility may also intensify. Next steps: position management. I am still holding the Nvidia exposure but will not increase the weight until I see consolidation around the USD 200 level. Monitoring: I am tracking major house updates and the company's fundamentals on a weekly basis. If additional significant price target increases appear, I will reassess the risk-return profile of maintaining the position. Thus, the portfolio remains on its planned path. Alongside outperforming the benchmark, the growth engines, led by Nvidia, are robust and have delivered substantial results since the first positions were taken on the 19th of March 2025. So let's see how the three strategies have evolved. Strategy 1, lump sum, one-time investment, blue line on the chart. The first investor bought an S&P 500 ETF on January 2, 2025, investing the entire $15,000 at once. They've held the position ever since. No additions, no withdrawals. Current performance year-to-date, 7.06%. The blue line reflects this result based on the most recent Friday closing price. Strategy 2, dollar cost averaging. Gradual investment, green line on the chart. The second investor splits the $15,000 into 12 equal parts, investing $1,250 on the second trading day of each month into the same S&P 500 ETF. This approach helps smooth out volatility and reduces the risk of poor entry timing. Current performance year-to-date, 7.67%. The green line reflects this strategy, slightly outperforming the lump sum method so far. Strategy 3, my fictional portfolio, red line on the chart. This portfolio is based on my own stock picks and investment decisions. It launched on March 19, 2025, with the full $15,000 invested in various individual stocks over multiple transactions. I've explained my choices in earlier videos. Current performance year-to-date, 28.64%. Note, these performance metrics exclude broker fees and taxes. They reflect only market-based price movements. Thank you for joining us on this economic journey with Test Portfolio XSX. If you enjoyed this weekly recap of the key events and our portfolio's performance, give it a like, subscribe, and join us again next week as we review the latest market moves and the progress of our investments. Disclaimer. This video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur.